Good morning, everyone. We're delighted to welcome you here to Grant Thornton's Budget 2026 webinar. I'm delighted to be joined by my colleagues Andrew Webb, Chief Economist in Grant Thornton, Peter Vale, an International Tax Partner, Jeanette Maxwell, Indirect Tax Partner, and Brian Murphy, Financial Services Tax Partner. Really looking forward to an insightful discussion on the back of Budget 2026 announcements yesterday, and in particular how it will impact individuals and the wider economy and businesses. I might kick off with the question to you, Andrew, just in terms of kind of the broader perspective on the budget. In your view, is Ireland striking the right balance between fiscal discipline and providing economic stimulus, particularly given the warnings we've seen coming from IFAC and the central bank?
Well, it's a beautiful question for an economist, because on the one hand and on the other hand is the typical answer I would give to this. I think when you look at the economy and you see that domestic prospects are good, that consumer spending has been strong and there's good momentum there, and we're seeing real wage growth, then you think, well, that's a real strong positive. Does the government need to intervene? And the answer is probably, in a traditional economic modelling sense, no. That would be counter-cyclical. But then, we do have a strong labour market, and that's been a real positive in the economy. But there are headwinds in our economy, and I suppose the most obvious of those is obviously the tariffs situation. But more fundamentally and more worryingly for the economy would be the things that are really starting to hinder the economy's competitiveness. And we see that in housing, and we see that in wastewater infrastructure. We see it in connectivity in terms of traffic and just lack of public transport. So we see it across so much of the economy that's starting to impact on the growth potential. So when you think of that element of our economic prospects and the role of government, we think the government should absolutely be in play. And I've some sympathy for the views of the Fiscal Advisory Council. I know the central bank came out earlier in the summer when the summer statement came out. I know ESRI came out, and I mean, my respect for those organisations is absolute. But on this, I think they're still looking back to the previous era of having to be exceptionally austere and manage public finances in a way that meant cuts and prudence. I would say the government's trying to strike a balance between prudent but also addressing those fundamental challenges that, if we don't get right, will really hinder the economic prospects for the country. And then as well, when you think about some of the other issues in play, like there are significant pockets of poverty and deprivation across the country. So, a government's role surely is to address that. So injecting the money they're injecting and doing it in a way that delivers, and I think delivery is the key point, and we can probably get into that later in other remarks. Then I think the government's right in injecting this money in. I think the language that they're using is about prudence and making sure that there are outcomes. So yeah, it's a fine balance. I think that they've faced into a lot of don't spend as much as you are, but my view would be they need to, and they need to then start making sure that the spending that they are doing delivers outcomes.
Yeah, thanks a million. And just picking up on that, I suppose foreign direct investment has played a huge role in the economy and the growth we've seen today. Peter, would you give us a flavour of the changes we saw come through on that side of things yesterday?
Yeah, normally you don't get a huge amount of detail in the budget, and the finance bill it's what's key. But we did see a few things highlighted, Sarah, yesterday. Improvements to the participation exemption, which exempts foreign dividends from Irish tax, came in last year. Some enhancements to that expected in the bill. Research and development tax credit up from 30% to 35%, so very welcome. The expansion of the SARP relief for foreign employees coming to Ireland, an increase in the threshold, entry threshold, which is a little bit disappointing, but a simplification of the regime, which is much welcomed. And again, we'll see that in the finance bill. And finally, an interesting tweak to the capital allowances regime for IP that's come to Ireland, and an adjustment to the balance and allowance calculation. Quite a technical one, but an interesting one. One actually that came in at midnight last night.
Thanks a million. And Jeanette, maybe just moving over to you on the indirect tax side, a similar question to what I had for Peter. Could you give us an overview of the changes that the Minister announced yesterday on in respect of that tax head?
Sure. So I think the VAT changes then can be categorised under three headings. So first of all, we have our hospitality, then our property, and then our energy. So on the hospitality, that was, definitely well flagged. So we've seen a reduction from 13.5% to 9% in relation to food and catering and hairdressing. So the hairdressing, I think, was a little bit of a surprise there. And interestingly, accommodation has been left out of that bracket, so it will remain at the 13.5% VAT rate. Another interesting point about that, its introduction is from next July, so July 2026, and no end date was given. So that may be an indicator that the reduced rate for the hospitality may be here to stay. On the housing front, again, we welcome the reduction in the VAT rate of 13.5% to 9% on the supply of new apartments. So that's great, and will greatly help the current housing crisis. And then on the energy front, the reduction to 9% on the gas and electricity, and that's until the end of 2030.
Yeah, so a bit of movement there. Yeah. Brian, moving on to the financial services sector, what would you describe as kind of the headline measures from Budget 2026 in terms of the impact for kind of operators within that space?
Thanks, Sarah. Maybe before I jump into that, and just a few interesting things, a lot of commentary in the last 24 hours about the budget. Two of the words that I've heard most frequently are brave and prudent. Really interesting to hear how Andrew marries those two together in discussing the output of same. From a financial services sector, we rarely see a whole lot of announcements in the budget, and that has been the case this year as well. The measures that Peter has referred to would equally apply across the financial services sector to start with. And the other two key things I think that are worth noting are, number one, a reduction in the exit tax for Irish and foreign equivalent funds and some life assurance products from 41% to 38%, being the first one. And then the second one really is just a continuation of what we've seen over the last number of years in terms of the level of engagement between the government and the minister in particular and the industry. There has been numerous, various different elements of consultation around lots of different areas across the sector, which is extremely welcomed. What's clear is that the government are engaging and listening. What is also clear is it is taking time to make any great movements. So that's really the case here. We would have, a lot of consultations over the last number of years have asked for various different changes. They're not coming through, but there is engagement and there continues to be consultation around same. Examples of that was the announcement that there will be a roadmap issued in early 2026 around the tax framework, which will again continue to focus on simplification of rules, maintaining the legislation in line with international norms, and then further movement on the continued review of interest. Interest is going to be very, very difficult in terms of complexities involved in interest taxation and the regimes around same. A commitment to continue to look at that is there. And then also, and we'll talk about this further on, the IREF regime and a commitment to continue to look at that is there as well. So the broad message really is continued consultation, which in real time is frustrating. You'd like to see more movement, but very positive that there continues to be that dialogue. And to be fair, the authorities are listening.
Yeah, I think that's right. I think there were a lot of roadmaps, references to kind of that longer term perspective and how we map out the journey to get to where we want to be. And maybe just picking up on that, I think in the R&D tax credit, there was reference to a compass in terms of where the R&D tax credit will go. And Peter, you mentioned it has moved from 30 to 35%, maybe one for yourself and Andrew. How important is that shift in the R&D tax credit rate, and how do you think it'll play into the wider economy and attracting kind of those high-end companies?
Yeah, and which I think is absolutely critical in terms of those stickier roles. And Brian's right, like they do listen, the department does listen, I think they aren't, but they don't always act. Sometimes they do, sometimes they kick it down the road. And you're right, there is another roadmap to look at more supports for innovation-related activities, which is good, which is a positive. So what did we see yesterday? We saw the credit increase from 30 to 35%. And this is an example of action. And they have taken, it's not a perfect regime, but they have acted, listened and acted. It is expensive, to Andrew's point, but it's money well spent. And there's plenty of studies showing that you do get a bang for your buck. And it's not just for multinationals. It's really important for the indigenous sector as well. And if you look further afield, you look at what President Trump is doing in terms of trying to attract R&D back to the US. This is trying to keep those jobs, those sticky jobs in Ireland. So it's a good counter to that. And look, we know there's not an awful lot we can do with our corporation tax regime. A lot of it is dictated from Europe or from the OECD. We can't do something on the R&D tax credit. We can make it as attractive as we can within those parameters. So really positive that they didn't just listen, they acted.
Yeah, thanks.
Yeah.
Any comments on that?
Yeah,
Andrew?
I think the R&D piece is absolutely crucial because we're seeing increasingly now, labour market challenges around availability of people, and one way to solve that is through automation and being more productive, and R&D goes to the heart of that sort of issue. I always think back to an OECD report from a number of years ago that looked at the productivity levels between our indigenous companies and our multinational companies, and a massive difference between those two cohorts. And when you think then, it's about pushing more productive practices into our whole company base, but particularly our local indigenous companies, and something like an R&D tax credit can only help drive that forward.
Yeah. And maybe just following on from that, we obviously, from a competitive standpoint, with the Draghi report, this criticism that Ireland is maybe less competitive and even wider from a European perspective. Do you think Budget 2026 has improved kind of Ireland's position from a competitiveness point of view in the kind of global platform, when you compare, to say, the US to companies further afield?
I'll let colleagues talk about, I suppose, tax competitiveness. I tend to look at competitiveness through the lens of economic growth, and the things that are holding it back would be currently the housing, the skills issues, the infrastructure issues. There definitely moves to try and address that. I think the language in the speeches yesterday from both ministers was not just about here's more money, but here we are trying to be pro-investment, pro-business, remove the barriers to planning and speed things up, and then actually see delivery. And I think that's the competitiveness that I want to see coming forward again. The cost of doing business is becoming increasingly difficult, and that makes us less competitive. The ability to attract people and recruit is becoming harder, and so we need to think of ways to make that more competitive again. So competitiveness for me tends to focus in on those drivers of productivity, and from a doing business and attracting business, tax colleagues can hopefully dig me out here.
Yeah, I would say, Sarah, on the tax front, certainly on the corporate tax front, look at the R&D. We are competitive. Our regime it's not the best, but it's one of the best, certainly in Europe. Our corporation tax rate, 12.5%, it's gone up to 15%. That's still really competitive, so that's good. Income tax, we're not competitive. And we haven't been probably one of the least competitive regimes on that front, which is really important in terms of attracting further foreign investment. That's been flagged by AmCham and others, but also creating that positive regime for entrepreneurs here. So we're certainly not competitive on that front, but competitive in other areas.
Yeah.
It's probably worth just the element of certainty. It's something that we have had for decades in terms of the tax regime, and that is maintained. And I think that is critical. Obviously, there's been big changes in recent years, but the majority of those have been driven by EU directives and OECD initiatives. So the Irish tax regime remains as stable as it can be, I suggest.
Yeah.
I think from a competitiveness perspective,
Yeah,
it's
which
very
is
important.
critical, isn't it? That certainty piece, and
And I think you're absolutely right, Brian, and successive ministers can take a lot of credit for that, because that wasn't an easy journey. For the last 15 years, there's been lots going on, but we still managed to maintain that position there in terms of the corporate tax regime.
Yeah, it does underpin a lot. Jeanette, just moving back to you, in terms of the VAT reduction, you mentioned the food and hospitality sectors. That was well signposted, but it was contentious. There was a lot of debate yesterday evening around whether it was the right move. Will it have the desired effect, or how do you see it playing out?
So I think this particular measure has been signalled as a job creation move as opposed to a consumer price intervention, and that's perhaps the nuance here. I suppose the problem perhaps might be the late introduction, like it's almost 9 months until 1st of July next year until it is introduced, and you have businesses in those sectors that have rising costs. You've got your pension auto-enrolment, your rising energy costs, inflation. and those bills need to be paid today, tomorrow and next month. So it will go some way to, I suppose, protect those jobs and keep those businesses open. But I suppose the late introduction of it has to be weighted against that. And then there's no differentiation between, you know, your small corner cafe against your large franchises such as your McDonald's, your, you know, five-star restaurants. So that's perhaps a drawback to the measure.
Yeah, perfect. Thanks a million. Brian, flipping back to financial services, you mentioned the reduction in the exit tax. We've gone from 41 to 38%. How do you think that will impact the investment landscape in Ireland? What do you think the implications of it will be?
Yeah, it's a very interesting one, Sarah, and one that's been asked for some time. And there's a couple of different elements to it. Number one is clearly the rate. It was previously 41%, which is significantly higher than global norms in the first instance, but also higher than our other rates here in Ireland. So if you even take our capital gains tax rate, it's 33%. There would have been maybe expectation is a strong word, but there would have been a hope that it would have gone towards a rate more akin to the capital gains tax rate. It has not, obviously. It's a 3% reduction to 38%. I would hope that it is a direction of travel that is being gone down here, and that there will continue to be a further reduction in the future. The fact that there's a reduction at all is a very positive step, I suggest. From an Irish perspective, there is a significant amount of wealth or deposits sitting in Ireland that could be invested in this space. I've heard the phrase over the last while or the reference to about 161 billion in deposits that Irish households have in Ireland, and that is a big bucket of investment potential that could be unlocked, but the rate is prohibitive at the moment.
Yeah.
There were other elements to this that were sought. So, for example, the 8-year deemed disposal rule, there was no reference to that at all in the Minister's speech. That's disappointing, because that would have been something that has been widely sought. And there are also on the life assurance product side, there's a 1% levy that is still there. And again, something that would have been sought to be removed, but there's been no change there. So a positive step, but there's a lot more to do there.
Hopefully, some done more to do.
No, I completely agree. And even if you did bring it to 33%, go back to the competitiveness point, like that's one of the least competitive CGT rates in Europe.
Yeah, there was a lot of talk around capital taxes, but actually it was probably entrepreneur relief was the only thing we saw come through on that side. Yeah. Peter, I know this is a topic close to your heart, exchequer receipts, and we've seen soaring corporate tax receipts. And I suppose, can you speak a bit to the importance of that and maybe how Pillar 2 changes might interweave with the direction of travel, and how reliant can we be on that aspect to fund the exchequer and future budgets?
Well, it is a fascinating topic. Nobody would disagree.
Yeah.
Like it's interesting, because normally we see the minister downplay the prospect of future corporation tax receipts, point to windfall taxes, and with the prudency lens there. Yesterday or the last week, it's been the exact opposite, and he has predicted corporation tax receipts next year to go up to 34 billion. We don't know where they'll exactly land this year, but probably around 29-30. So quite a big increase next year, and that is driven by the global minimum tax, the new 15% rate, which we'll start collecting next year. There was some talk earlier this year, would that not come in? Don't think that's that's going to happen. We are going to see the 15% rate be collected next year. So that is what's going to underpin the increase in those corporation tax receipts next year, which is really critical to fund lots of things that we want to fund as a country, both current and capital spend. The other reason he thinks it's going to go up is because Pillar 1, which is the bit that would have taken some of those taxable profits away from Ireland, now looks dead. There is the threat of digital taxes coming in from other countries, which could eat into our corporation tax receipts, make us less attractive, maybe over time eat into that, and that's a real prospect. I think, though, probably the biggest danger to our corporation tax receipts is the fact that we're so reliant on such a small cohort of companies, and that percentage of corporation tax that the top 10 companies pays is actually going up. It's creeping up every year. I think last year was at about 57%, up from early 50s the previous year. So we're becoming more reliant on a very small cohort of companies. If even one company left, you're going to see a big drop in corporation tax receipts, and that's why I think we need to keep trying to support FDI here. It's been really great for the economy, but also make sure there's a good pivot and a hedge for a domestic indigenous sector, which you sort of feel we should be able to do more with, given how much multinational spawn in terms of Irish domestic spin-offs.
Yeah, yeah, and it's probably not dissimilar to the income tax. Like definitely the top income earners are paying, more than their fair share of the overall income tax take. So there's probably analogies between the two tax heads, but maybe to a lesser extent.
And it is, as you know, one of my other favourite topics, that we have seen no movement in marginal income tax rates. And not just that we've seen no movement, we didn't certainly expect to see anything in this budget. I would have personally liked to have seen something maybe over the previous few budgets, but we don't even see any, there's not even any mention anymore of income tax rates. And you go back to the competitiveness point, and maybe we're happy as a country that 52% or 55% is appropriate for workers to pay tax. And it just doesn't seem, and there is a tipping point, it just doesn't become, you can't be incentivised. There's basically no point working at a certain level at a tipping. It feels like we're past that. And again, back to the point that we can't do much with a corporation tax regime. We have to do what we can with the other bits of it. And that it's a glaring omission that there's not even, we talk about roadmaps, there's no roadmap over the term of this government. He did talk about progression, but I don't think that's in the context of rates. So I think over the term of this government, I would be very surprised if we're going to see any reduction in those marginal rates.
Yeah.
And Peter, sorry, that what would you do? Like in terms of marginal rates, I think it's interesting. It's always talks about the marginal rate, but is there things that could be considered in that?
Yeah, like I would commit to a top rate of 50%. That's what I would do for employees and self-employed. I think would it be self-funded? I think to a certain extent it would. They never project that, but I'm sure it would. Would encourage probably some more compliance. That's the reality. I would broaden the tax base. There's talk of that. We're not really seeing that happen. And then it's a bit controversial, but you could see, and we talked about it last night at the dinner, and the assets that are in the country, property is a huge part of that. We do have property taxes. They're at a really low level compared to our European counterparts. Now that's controversial, but it's a way of broadening the base and generating more revenues and enabling us to reduce those marginal rates.
Yeah, which was in the Commission taxation report as well, wasn't it?
Yeah.
To move to that kind of tax system as opposed to everything being linked to income.
Look, it's politically difficult. It's unpalatable.
Are you hinting at a wealth tax now, Peter?
Yeah. Well, I mean, look, we have property taxes. We have that in place, but it's, as I say, it's at very low levels. If we were going to see anything on that, though, it's the first term, or your first budget where you're going to see that.
Yeah.
We didn't, so the odds of seeing any movement of that, I think, are pretty remote.
And I'm curious, Andrew, your view on wealth tax?
I'm all for it.
You're pro?
Pro, absolutely pro.
Good for the economy.
Yeah. I think it's just, I was writing about this from a UK perspective recently. It's an area where it's very undertaxed. There are some significant assets that people hold, and it might be difficult to bring in things like the value of art and whatever else might be in the asset base. But Peter has articulated very, very well there just the reliance on corporation tax and issues around income tax. I think we definitely need to be thinking about broadening the tax base and making us less reliant on those corporation tax receipts. I'm less nervous about the corporation tax receipts. I read things like we'd be in deficit if we didn't have the corporation tax receipts. Well, we do, so we're not. And let's enjoy it while we have it, and let's invest it wisely while we have it. But let's also have one eye on how do we extend out our base and become more fiscally sustainable.
Yeah. So we've spoken a lot about the tax measures. I suppose on the spending side, Andrew, you've touched on it in terms of setting up for future success and infrastructural investment. How do you think Ireland is set up for success in terms of the signposting and the future commitments to spend on that side of things?
I do think it's an area, it's clear it's an area where we are falling down pretty badly, and it's the delivery. So, we've had money to spend for a good few years now, but we have not addressed some of those major challenges that we face. The housing is the most obvious of all of those, but big infrastructure projects just aren't moving at the right pace to make a difference. So the language yesterday, I was reasonably encouraged, was a mix of caution around, being prudent, but also we need to get better at actually seeing these things through and delivering. So removing some of the pain points about delivery and trying to just be pro-activity, I think will help us. Now, in a year's time, we want to be looking back and thinking, okay, we're starting to see more commencements on building and we're starting to see permissions coming through on metro links, but we now need to start seeing delivery on the ground and completion on the ground. Otherwise, what's the point of all
Call
this?
to action, Andrew.
Yeah, get busy.
And Jeanette, that probably links in with the changes we saw on VAT and apartments. I think Karen Holmes were out last night saying that they could see apartments drop 80,000 on the back of the change to 9%. There was a lot of pushback initially around changing the VAT rate on the property sector. Do you have a view on the change in approach, and was it a good thing, I suppose?
Yeah, so there has been a lot of lobbying for many years in relation to this VAT rate cut, and I suppose what really pushed it on this year was that the government are behind in their commitment to deliver 300,000 homes by the end of 2030. And in the apartment sector alone, that saw a 24% slump last year. So we are behind. So a measure, I suppose, really was required. VAT is an EU tax, so we are constrained by our EU VAT directive as to, I suppose, how low we can go with the VAT rate. So, for example, the government weren't in a position to have a zero rate on the apartment, so a reduced rate of 9% is where they could go to. So I do think it is welcome. It's on the supply of apartments only, as are defined in our tax legislation, and it has to be as part of a social policy. And again, that's coming from our EU VAT directive. So we're yet to see what this social policy will look like, or the parameters of it. But I do imagine it will be quite widely drafted that it should include all apartments. So it will help, to stimulate in the urban areas where there is apartments, and that's where they want development, that's where people need the houses. But I suppose if you look at the rural, cities and towns, it's going to be a bit, of a disadvantage then to the first-time buyers in those rural areas, because the measure doesn't apply to a house, it's to an apartment only.
Yeah. Thanks a million. And Brian, maybe just sticking with the theme of property, the Minister mentioned IRF withholding tax in his speech yesterday. I know that's been kind of a difficult area for a lot of institutional investors in terms of how they deal with it.
Yep.
Would you mind speaking on that point?
Yeah, so that specific point, Sarah, is absolutely correct. So there's a lot of frustration around the withholding tax regime applicable for IREs. What's happening effectively is that there are investors who are entitled to an exemption from withholding tax, but due to the complexity of the rules, they suffer the withholding tax initially and then have to go and reclaim. And it is taking years to process those reclaims at the moment, due, to be fair, to the complexity of the regime. But it's simply something that is unworkable. It's causing a significant amount of frustration for investors. And these are investors that, frankly, we need in the system. Yeah. So there's a commitment to, there's another layer of what was mentioned was the fact that the funds sector 2030 report had asked for a reconstitution of the entire regime. So the Minister has said that will not happen. He's not going to rip up and start again.
Yeah.
He is committed to a process of consultation to simplify the regime, and clearly the withholding tax element will be part of that simplification. So something that is extremely welcomed. And the other point to that Funds 2030 report had asked for an entry-level taxation at the level of the IREF as well. Yeah. That has happened in other jurisdictions, and what that really does is just add, again, more complexity to a regime that is already complex.
Yeah.
It has caused significant consternation in the Netherlands, for example, without increasing the tax take, it needs to be said, just complexity. So again, the Minister is committed to no entry-level taxation regime coming in. So really the direction here is we want to maintain the regime. We want to maintain the tax take from the regime, which is very important, but we want to make it easier to use.
Yes.
And the commitment is really welcome.
Yeah.
Right. And just to add, I completely agree with that. And I think, you're right, it's unworkable. And if you might remember, it came in back in, I think, 16, and it was reactionary. It was reaction to the so-called vulture funds, and we've seen that, and hence it had to be written quite quickly. And we've seen that over the years, where you've got reactionary legislation written in reaction to particular concern. There are issues with it that then need to be amended and repaired. So positive that they are looking at it, but we've had 9 years now of unworkable legislation concern, which has impacted on investment.
Yeah, yeah. And in a more positive vein, we brought in a participation exemption for dividends, Peter, from the start of this year, and the Minister did reference changes being made to that. Would you mind elaborating on what those changes were?
Yeah, so it was a positive. Again, we would have liked to have seen the participation exemption for foreign dividends come in a lot longer, many years ago, and there was a commitment to do that. But look, we got it in last year, which was positive. So, and it doesn't necessarily. It was interesting when you look at how much the cost of that, it doesn't really cost the Exchequer anything, because when Irish companies receive foreign dividends, they're generally sufficient credit, so you don't pay any more Irish tax. But it was complicated, a lot of very unnecessarily complex calculations to get to that. So very positive, simplified it, and really just mirrored what other countries do. Back to the competitiveness point, practically every other European country would have that exemption for foreign dividends. So we brought that in last year, didn't bring it in quite as wide as we would have liked to have brought it in terms of the ambit of it and what foreign companies were within the scope. Slight improvement on that. Again, we'll see the detail in the finance bill referencing countries, so dividends coming from countries that do apply a withholding tax. So you'd imagine it's going to keep outside the remit pure havens, but countries that do apply withholding taxes will now be within, that aren't already within the remit, so non-treaty countries, but that do apply withholding taxes look like they'll now be within the remit of it. And some other positive sort of tidy up points around the legislation. So yeah, look, it's to be welcomed.
Yeah, perfect. Andrew, just coming back to you in terms of government supports, and I appreciate we've probably spoken a bit to it, in terms of Indigenous Irish businesses and entrepreneurs, how are we set up for success on that side of things? We've spoken about the FDI, financial services, property, but in particular that kind of cohort.
Yeah, I think I would have probably liked to have seen more on explicitly on creating a more dynamic entrepreneurial system and a support to our Indigenous companies. I think that probably would have played into more of a regional initiative as well, you know. But I think it probably didn't get a lot of headlines, or certainly wouldn't get the big headlines. But I was very pleased to see moves around making it easier for the Irish Stock Exchange and taking measures there. Grant Thornton were very glad to support on some research a few years ago to look at why companies weren't listing on the stock exchange and the barriers that was hindering that. And I suppose the ultimate point was, you know, a dynamic and a vibrant stock exchange is part of an ecosystem that is, you know, really important in the mix of, you know, the entrepreneurship journey. So when you start, you would hope that there's funding and support there and equity that can be brought in. But as you start to move up the value chain and scale, just there were too many barriers there that was causing companies to leave the stock exchange and just not enough investment appetite there. So making moves in that direction is part of, I suppose, just increasing that ecosystem, and that will ultimately support our Indigenous businesses. I think as well, I probably would have liked to have seen more around skills, though. I think, you know, when we've such a challenge around the labour market, full employment, and that's really, really positive. And, you know, the labour market's been an absolute star of economic performance for a number of years, but it's really difficult to find people now. So when we're working on skills forecasts, we're seeing gaps left, right and centre and in key areas. So it's really hard to find people. I would have probably liked to have seen more explicit intervention on skills and upskilling when we're facing into an AI revolution and automation and all that comes with it. So probably, you know, overall a good budget, but I would have liked to have seen more explicitly in the small business, Indigenous business space.
Yeah, and Peter, I know that share schemes is quite topical, it comes up, like we don't really have any competitive schemes compared to other jurisdictions in terms of incentivising the labour force and kind of employee inclusion. There were some references to KEEP and FED, a couple of things around that.
Yeah.
Any thoughts on that side from a tax perspective?
Yeah, some improvements to FED. I think Turkey and Philippines maybe were the two countries that were extended for that. So that's positive. And the threshold, I think, is up to 50,000 now as well. So a bit more meaningful for FED, which is to, you know, help Irish businesses trying to expand abroad. It gives some income tax relief. So that's positive. We talked about SARP earlier, which is different, positive, some positives and negatives in that. Keep is a very worthwhile scheme, and it's maybe symptomatic of things that we've brought in over the years that on paper are really good, but when you get into the detail, they don't really work. They're unworkable.
Yeah.
And they just can tie themselves up in knots writing it so they can't be abused, but then it doesn't work. Which you got to protect the exchequer. It has to achieve its intended outcome, but it's not. And you're right, we've really low share ownership in Ireland. Keep is something that might have helped move the dial on that, but it's just, there's a nervousness about doing too much. And you could point to things like EIIS as well, which is another really well-intentioned relief in terms of for small Irish businesses, which we're really trying to promote, trying to raise non-bank finance. It should work, very attractive for the investor and very attractive for the company trying to raise the finance. But many firms really don't want to even advise on that. It's just so complicated.
Yeah.
Some of it driven by Europe, but bits of it that we could do better.
Yeah, and the entrepreneur relief, you're obviously happy with that.
Yeah,
Yeah,
and that was,
yeah.
there's been a lot of lobbying over the years to try and improve our entrepreneurial relief. At one point to try and mirror the UK, and then the UK brought theirs down, so we dropped that line. We'd sort of given up on the lobbying because it felt like nobody was listening, but then unexpectedly yesterday, because we thought maybe it wasn't being listened to, the relief, the amount that you can achieve, the 10% CGT rate went from 1 million up to 1.5 million. That's a lifetime limit. So that was very positive for entrepreneurs.
Yeah, thanks a million. Brian, in terms of the outlook for the financial services sector, any views on that?
So the outlook, I think the outlook is continuously positive. Right?
Yeah.
We've a very well-established industry here, seen as a good place to do business for the industry. There continues to be challenges with some of the products we are using to support that industry. Product we've mentioned various different elements of complexity in the regime that is there. Notwithstanding all that, though, I think it is very clear there's a lot of engagement with the authorities through companies like ourselves, but through the various different industry bodies. And those industry bodies are put a lot of effort into ensuring that when there are consultations, that there is adequate representation of the market, and then at the flip side, the authorities are listening. I think what we're seeing is plenty engagement. We just need to see a bit more action.
Yeah.
So we tend to see some action through the finance bill. So we'll wait and see, will some of the measures we have asked for come through that? Hopefully they will. I think it's a slower burn. So really, from an outlook perspective, I am very positive, but it just takes time.
Yeah, good to hear. And Friday week is finance bill, so I think there'll be a lot of detail, a lot of interested parties in that. I've one question now for each of you in terms of missed opportunities. If you could pick one thing that should have come through but we didn't see yesterday, what would it be, or what's in the wish list, say, for Budget 2027? Andrew, will I start with you?
No. I suppose I touched on it there previously. I think, for me, doing more on regional balance and regional growth, I think probably would have been a good thing for me. But as well, we're massively behind on our climate change endeavours, I think, to really start to amplify that. So when I think about the money that was injected in yesterday, and people can have a different view as to whether it was prudent or whether it was brave or whether we shouldn't have spent as much, to go back to the overarching thought at the start, we've some fundamentals that we're just not addressing, and they are going to require massive amounts of investment, and one of which, there are many, but one of which that I didn't get a sense of yesterday was climate action and addressing that. So I think to get really, really proactive on that should be the focus of future budgets.
Yeah, there wasn't much in that space at all. Yeah, Peter?
Yeah, of course, I'm going to be repeating myself. So I wasn't expecting any decrease in income tax rates or in CGT rates, but we've talked about plenty of roadmaps and consultations, which we are expecting over the next couple of years. It would have been nice to see even talk of a roadmap for both of those tax rates. We didn't see that.
Yeah, okay, thanks.
Yeah.
Jeanette?
Yeah, I just have another point that's probably worthy of mention, just in relation to VAT and the digital age and the VIDA changes at EU level.
Yeah.
So Revenue had an open consultation that ran last year, submissions from ourselves, from academics, various industry bodies, and then it sort of went quiet for the last sort of year and a half. So interesting yesterday that Minister Donoghue announced that he would be introducing a phased rollout of e-invoicing, so domestic e-invoicing for business-to-business supplies here in Ireland. So he didn't have to press go on that for another, 5 years if he wanted to. So it's interesting that after, sort of a silence for quite a considerable amount of time, now the green light has been pushed on that. So, that's a significant change for businesses in the way that they do their invoicing, affecting not only their VAT function, but their wider finance function, their technology, their operations. So I suppose we wait to see what the phased rollout will look like there.
And the timing, Jeanette, on that?
No timing given,
Yeah.
a transition
Okay.
period. So we expect that'll be a considerable amount of time because, small businesses especially simply wouldn't have the infrastructure in place. They may need to, hire extra resources to be able to accommodate that change.
Yeah.
So that's something that was a surprise that we definitely didn't expect.
Yeah.
Because Ireland was quite behind in terms of the other EU countries, and now suddenly we're
playing catch up.
Yeah, we're playing catch
Yeah.
up.
And in terms of your missed opportunity or what you'd like to see coming down the tracks?
Yeah, so I think, when we think of the hospitality sector, the hairdressing sector, they, obviously it won't, solve the jobs issue overnight and the rising costs, but it will go some way. So then you have to think about, perhaps your exporters with the rising costs, the concerns, all the uncertainty over the tariffs. It would have been nice to see some, form of incentives or grants or additional supports there for exporters, especially, in the pharma industry where there is so much uncertainty and, people are adopting a wait and see approach. But it would have been nice to see some support for exporters.
Yeah, perfect. Last but not least, Brian.
Sorry, I'm just upset you've only given me one off my wish list.
Feel free to keep going, Brian.
Which one I'll go with. So I'll stick in my box, which is the sector I operate in, and my wish list would be reform of the double tax credit regime. Again, tune of a lot of what I said already about complexity.
Yeah.
It's really, really complex. It absolutely needs reform, and that is something that I would. And I think there is a chance that we'll see it in the next 12 months through the Finance Bill 2026, but a reform of the double tax credit regime, I think, is something that's required.
Yeah, super. Listen, thanks a million all for your insights and thoughts on budget, and thank you everyone online for joining us for this session.